Professor Monir. Professor Monir, you have to unmute yourself.
Yes, I just unmuted. I'm just checking how I can share my screen.
Yeah, welcome, Professor Monir. And you have present now option. And in that you go inside and there are 3 options. Your entire screen, a window, a tab. Whichever you want, you can choose. And only one tab. If you choose your entire screen will be visible to us. Then anyhow, you're going to use only your PPT that you can open and that will be seen by us.
So a window is, what is that?
Your entire screen also you can do, Prof. Better.
Entire screen?
Yeah.
Okay.
You select that box and then share.
Okay, I'm trying.
Yeah, we are able to see your screen.
Are you able to see it?
Yes, the PPT.
Okay, good on you. Thank you very much. I was very stressed out about it.
First of all, happy Eid, Professor, and advance Ramzan wishes. There are a lot of Islam students in this course, and they were kind enough to join for today's class. As there is no mass prayer in the mosques, they are doing the prayers in their home itself. So you can also wish them the festive season greetings. Actually, here the situation is really bad, but we are managing safely. So
yes, yes, we are a bit lucky in Australia, to be honest.
Yes.
So anyway, good morning, everybody.
So, Prof, I will also introduce you to the students. Then you can proceed with the things. Yeah.
Sure, please.
You can speak informally for some time because some students are joining. 19 students have joined. Still, some more students have to join. We'll wait for exactly 8 o'clock. We'll start the session, Prof.
So it's already 8 o'clock, I guess.
Yes. Here it is 7:58.
Okay. Here it is 12:31. So,
Prof, my scholar Habib Rahman, have you met? Habib, can you open up your video? He is
hello, Professor.
Habib.
Yes,
myself,
Habib,
Rahman.
I heard a lot about you. I'm okay, thank you. Yes.
He's helping the project, and he visited Deakin University for 3 months.
Yeah. I missed you when Professor Charamati visited Canberra.
Yes.
We're expecting you, but
we were planning.
I don't know. Yeah. Okay, next time maybe.
Yeah, sure.
Yes.
Thank you.
So
how many students were supposed to get?
38 students are there.
Okay, 38.
And 2-3 students got a waiver because they are affected by this pandemic.
Oh, I'm sorry to hear that.
Maybe 30 plus will join, I'm hoping.
Okay.
Now 8 o'clock. We'll start the session, Prof, with your permission.
Please go ahead. Thank you.
Yeah. A very good morning to all the students present here. And I take this wonderful opportunity to welcome our Professor Monir from University of Canberra. So this is part of the SPARC project, a very prestigious project of Ministry of Education. We got 5 million Indian rupees for this project. And the main purpose of this project is to make available the best talents in the world to the particular university which has got this project. So in that respect, already we have one Dr. Lakmika from Deakin University, and now Professor Monir, a very senior professor of accounting, is with us from University of Canberra. Of course, this project is a collaborative international project, and here we have Deakin University, Foreign PI, and University of Canberra, Australia. Again, Professor Monir is the PI, and from India, Pondicherry University is the main PI, and Amity University, Dr. Hema Bindukota is the co-PI for this project. So here I have great pleasure in welcoming Professor Monir. About Monir, I have to say some words. Professor Monir is a professor of accounting in the School of Information Systems and Accounting of the Faculty of Business, Government and Law, University of Canberra. Previously, he served as Associate Dean Education, Associate Dean Research, Coordinator of HDR Students, Member Faculty Research Committee, Member Faculty Education Committee, Staff in charge of professional accreditation of accounting courses and maintaining liaison with accounting professional bodies in Australia on behalf of the Faculty of Business, Government and Government, University of Canberra. He held academic positions at the University of Wollongong, the University of New England, and at the University of Dhaka. He holds a PhD in Public Sector Reform and Accounting from the University of Wollongong. He received his MBA in Accounting and Finance from the Catholic University of Leuven, Belgium. He is an FCMA, FCPA, and a former bank executive. He teaches in the area of management accounting. Professor Monir has presented papers at various international conferences, including the Critical Perspectives on Accounting Conference, very prestigious conference, the Asia Pacific Interdisciplinary Research in Accounting Conference, the Interdisciplinary Perspectives on Accounting Conference, the Asian Academic Accounting Association Conference, and the Conference on Emerging Issues in International Accounting. Professor Monir's research has been published in leading international journals, including the Accounting, Auditing and Accountability Journal, the Financial Accountability and Management Journal, and in the International Journal of Public Sector Management. Professor Monir is the international co-PI for this project. And apart from all these credentials, he is a person of very, very humble and simple. And when I visited Australia, Canberra, he was so nice to extend the maximum hospitality. And I was so much impressed, Professor. Thank you so much. Actually, our students are little unfortunate. You should have come here, and by this time they would be actually interacting with you physically. But now, by God's grace, at least you are able to give 2 lectures. We are very, very happy to have you in this course, because you are a senior professor. Your inputs are very, very valuable for our students. I welcome you, Professor, again. With these few words, I now hand over the session to Professor Monir. And students, you may really enjoy his session, because I have heard him there, and he has given a lot of opportunities to the students there. And also when I visited also, he gave me a research seminar opportunity. We'll never forget Professor Monir, and all these collaborations definitely will continue beyond this project. With these few words, I hand over the session. Thank you, Professor Monir, for joining.
Thank you, Professor Charumathi, for a long introduction. I'm feeling a bit humble anyway. And good morning, everybody. And those who are celebrating Eid today in this group, I wish you all Eid Mubarak. So our today's topic about 3 standards of IFRS for SMEs. Now, what I did, I summarized these, the main points of these standards: disclosure, recognition requirements, measurement requirements, from a textbook, McKenzie et al., and from the standards directly. Now, I know that you are not accounting students, and I'm an accountant. I am really, I really wanted to show you my accounting skills of the application of these standards, but I think that will be too much for you.
Sorry to interrupt, Professor. Actually, yes, this meeting is being recorded, Professor, with your permission. Okay? Thank you.
Please go ahead.
Yeah.
So I prepared my lecture notes, bearing in mind that you are not accounting students. Now, as I proceed, you can raise your hand if you have got any questions, but you are a bit shy, do not want to ask question now. You can always send me an email later, or if you don't want to send me a letter directly, you can send email to Professor Charumathi, who can forward it to me, and I can of course respond to you. And hopefully this session is going to be enjoyable, but remind you that these standards are not very enjoyable. They are really boring, but I'll try to make it enjoyable. Okay, so as I said, that Our topics are today about 3 standard of IFRS for SMEs. Standard or Section 23 for revenue, Section 24 for government grants, and Section 25 for borrowing costs. Okay. Before I proceed, I'm assuming that you have got understanding by this time what SMEs mean by this standard. Okay. And of course, you have got understanding that why standards are actually needed. But nevertheless, I'll briefly highlight why standards are needed. The main purpose is that if all entities, they follow these standards, then we'll have got kind of a uniform financial statement. And when you get a uniform financial statements of these entities, it will be easier for users of these statements to compare and make decisions. And of course, you know who are the users. They're mainly the external users. External users are something like creditors, banks, government regulators, suppliers, those kind of people, including owners, if the owners are not involved in day-to-day business, day-to-day operation of the entities, okay? So these people take a lot of decision based on the information provided in a statement of financial position or financial statements simply, and that's why standards are needed. And around the globe, that is why many countries, they are making it mandatory that entities should follow some kind of standards. And I think India is going towards that. Probably they will make it mandatory today, tomorrow, the application of IFRS for SMEs, okay? Even they are not mandatory, many entities, they follow these standards voluntarily. Okay, so what happens is that you're not an accountant, probably you're not going to check the actual calculations based on the standards, but if you've got some knowledge, if you're sitting in a managerial position, when the statement comes in front of you, you can just quickly scan and browse, and you can say that, look, well, we have followed this standard, and the users will really appreciate it. That is what you should be aiming at. Okay, now do not try to memorize this. I mean, it will be deadly if you try to memorize all the sections and all the requirements and everything. Try to use your understanding conceptually, that what is actually mean, what is actually required, and what I'm going to disclose, recognize, so that it is actually usable by the users of these statements. So try to understand. That is what I always say that, all right? So for example, revenue, the term looks very simple, isn't it? Okay, I do business and I have got revenues. I'm going to just show it in my financial statement. But apparently it looks very straightforward, but it is not actually that straightforward, because there are subjective judgments involved in it, in recognizing revenues, okay, and in disclosing revenues. So that's why to maintain uniformity, we must follow these standards, okay? So having said that, now let's go to the first section, section 23 of today's lecture, revenue. First, we need to understand what is revenue actually. Well, there is a dictionary meaning, or if you give a Google search, you'll of course get the meaning. But the meaning that we want to learn is from the IFRS.
Professor Monir, sorry to interrupt. Can you present that slide, Prof, by slideshow? So that it will be little bigger in the screen.
Okay, I don't know how to do it.
Actually, in the right bottom, you see, Professor, there is a, in your PPT, or you go to slideshow. Slideshow. In the top left, you see file, home, insert, draw, design, transition, animation, slideshow.
I see a whiteboard, full screen, background.
No, not in the PPT.
Near zoom, you are in left, sir. Near zoom.
Or you can simply zoom, Prof, a little bit. 88% it is.
Near zoom, left side, left side.
Okay.
Left side, there is a, like a TV screen.
Yeah.
Is it okay now?
Okay, Prof. Okay, Prof.
Okay, all right.
Yes,
So sorry for that anyway. I'll try to learn that one later. Thank you. Okay, so what is revenue? As I said that, well, the terms look simple. Yeah, it is simple. That is true. But let's follow what the standard says, okay? The standard says that revenue means gross inflow of economic benefit in the course of ordinary activities of an entity. First thing, okay? Gross inflow of economic benefits in the course of ordinary activities of a business. All right. So this term, ordinary activities, is very important. It means that a business is dealing with a particular goods and they sell these goods for the revenue. So that is going to be recognized as revenue. But if the business buys lotto or lottery, for example, and gets a $1 million, and that is, of course, kind of an income, but that will not be recognized as revenue for the purpose of financial statement, okay? But can be shown as an extraordinary income in the financial statement. So revenue is going to be gross inflow of economic benefit that arise out of ordinary activities. And the second condition is that this revenue is going to increase the equity of the business. How is it going to increase the equity of the business? What is the equity of a business? The equity of business is that, in simple terms, if we deduct total liabilities of the business from the total assets, there's going to be the equity of a business, okay? Now, whenever a revenue is generated, the revenue is going to increase the income of a business, and the income is then going to increase the equity of the business. But if a owner or group of owners contribute additional capital, all right, that is also going to increase the equity of the business, but that's not going to be revenue. So these are the two conditions that defines what revenue is. And this section deals with three kinds of revenues, particularly one of them is sale of goods, revenue generated out of sale of goods, revenue generated out of sale of services and providing services, and revenue generated out of construction contract. And what is a construction contract? Of course, a construction contract is a contract through which an entity constructs some kind of an asset, one asset, or a combined or a combination of related assets. Okay, so that is what is revenue according to the standard. Okay, now how revenue is measured? All right, well, looks bit again or very straightforward term, isn't it? Well, I sell goods for $10, and that $10 is going to be revenue. Yeah, you're right, absolutely. That's $10 is going to be your revenue. But this is not that straightforward always. And that's why standard actually gives us some guidance how we are going to measure the revenues. So it says that revenue is measured at the fair value of the consideration received or receivable. Revenue is measured at the fair value of the consideration received or receivable by the entity. Okay, standard actually guides us or tells us that there may be three types of measurements that we can use in our business. One is a fair value, another one is a historical cost value, and other one is amortized cost value. All right, but you'll see that as you progress through this subject and you get some kind of knowledge about these standards, you'll see that in most of the cases the standard actually advising us, recommending us, suggesting us that we use fair value, fair value, fair value, and fair value. Okay, so what is a fair value? Of course, this standard also defines fair value in its section 2.34 and subsection B. Okay, so fair value is the amount for which an asset could be exchanged or a liability is settled. Amount for which asset can be exchanged or liability settled between 3 points, 3 features, remember, between knowledgeable, willing parties in an arm's length transaction. This definition has got huge implications. So as I said that do not always try to memorize, try to understand the implication of a definition, what the definition actually is saying. So saying that between knowledgeable persons, okay? So for example, I'm doing a business of selling paintings, all right? You know, paintings, they are sometimes painted by renowned artists and all those things. And the person who will buy should have knowledge about the painting before negotiating the price. If not, then the price to be settled will not be fair. So the person who's selling and person who's buying, both of them should be knowledgeable about the stuff which is sold, all right? Or about the service which is provided, or about the construction contract which has been provided, okay? Then willing parties, all right? I'm selling paintings and I go to your home with a gun and put it in her head and I say that, look, you got to buy this painting at this price. And seeing the gun, okay, so, okay, yes, sir, I'm going to buy it. You pay me the price. That price is not going to be fair value again. So both the parties, they willingly go ahead with the transactions. And the third one is very, very important, all right? Arm's length transaction, all right? So you are doing a business, selling some goods, some stuff, and your dad comes, your father comes, and you sell him half the price of the market. So that price is not going to be fair value, all right? So it has to be arm's length transaction without conflict of interests. So that is what fair value is. So the revenue recommends that the revenue should be measured at its fair value. So this fair value, of course, needs to be adjusted for any discounts provided, all right? Any prompt settlement discount provided, or any rebates provided. And when you make the adjustment, the amount that you'll get, that is revenue that you're going to actually measure and you're going to disclose. So if you do that, your business do that, another business do that, another business do that, all of them follow these fair value suggestions from the IFRS, then we can really compare the performance of all these three businesses on the same boat. That is the purpose of the standards, okay? Now let's see the next slide, an example for you that how fair value is calculated. So this is not a rocket science, these calculations. Anybody can do it. You're not accountant, but don't think that it's a calculation for accountants only. So see that a company called Amsterdam sell goods to Paris, $114. Apparently, it looks like that this $114 is going to be revenue for Amsterdam. But if you go further with the example, you see that of that $114, there's a 14% value-added tax, okay? And also, Paris is given an incentive. If Paris pay within 30 days, Paris gets 5% prompt payment discount. And Amsterdam, from its experience, always found that Paris never fails within that 30 days, all right? So what will be the revenue for Amsterdam? How we are going to measure the revenue for Amsterdam? That's pretty straightforward. As per the definition, you start with the gross cash inflow, which is $114. That's not going to be revenue for Amsterdam. Of that $114, 14% VAT, which is need to pay it to the government, to the tax authority. So Amsterdam is left with $100 as its revenue. But as Paris pays within the 30 days and receives 5% discount, so revenue to be recognized by Amsterdam, to be measured by Amsterdam as $95. Okay, that's very simple. As I said that, if all other entities, they follow these, we can then actually measure their performance. We can then compare their performance. Okay, so any questions so far? You can raise your hand or you can note down your question. If you don't want to ask me, as I said, you can send me an email letter or you can send an email to Professor Charamati. Any questions? Okay, if not, then I'll go ahead. So the next topic is there may be an issue. Sometime a business work as a principal and employs as agents who who buy and sell goods on behalf of the principal. All right? How are we going to measure revenue? How are we going to recognize revenue in that situation? We need to separate the commission paid to the agents and the net revenue received by the principal. Okay? And the agent, although receives money on behalf of the principal, agent is not going to recognize all the money as its revenue. Agent is only going to recognize the portion of the commission as its revenue. So this is a principal agent scenario, but other criteria for measurements equally apply to both principal and agent. Okay, now in some kind of transactions, sales transactions, there are some deferred agreements and there are some financial elements, right? Suppose you're selling goods and saying that, okay, you got to pay me in 4 installments, all right? And the installment may be interest-free, the interest may be with, the installment may be with interest. Again, if you allow 4 installments for 4 years, all right, in your reporting period, you are going to recognize only that much of revenue that you actually received in that particular year, not the whole of the revenues that you'll be receiving next 4 years. Okay? And if there is an interest element in it, then you need to segregate the installment payment into the principal payment and interest payment. Then you show the principal payment as your revenue out of sale of goods, and the interest payment is another income like interest income in your financial statement. So see that the standard is very clear, giving us very clear guidance what we're going to do. And as I repeat again, that if all entities they follow these, we'll be able to compare their performance easily. All right. Then the next issue is about exchange of goods. Sounds funny that, well, it's kind of a barter system which existed 1,000 years ago, but there are still barter or exchange systems. Some organizations exchange goods instead of paying cash. Okay, I'm giving you this good, and in exchange you give me that good. All right. So that good which is coming, or the goods which is actually exchanged, we need to find out how much revenue to be measured and which is going to be our revenues. All right. So there are some criteria, and very simple, very easy. Do not try to memorize. I'm saying it again. All right. Very simple. So when goods are exchanged, what you're going to do, first find out whether these exchanged goods are dissimilar goods or not. If they are dissimilar, and that is when on the revenue will arise as per the standard, and you got to recognize it and you got to disclose it. Okay. If the goods are of similar nature, then there is no revenues, no revenue transaction. They don't need to be measured. They not to be recognized. Even goods when are exchanged and they have got no commercial substance, very minimal values or something, you don't need to recognize as revenue. So the basic criteria is that the goods, they have to be dissimilar. So how to measure revenue? The first thing is that if you can determine the fair value of the goods that you received in exchange of goods that you paid, okay, you need to recognize that much as your revenue. Okay, now suppose you cannot calculate the fair value of the goods that you have received. In that case, the goods that you have given up, the fair value of the goods that you have given up can be used as the revenue for these transactions. Okay, suppose you cannot even determine the fair value of the goods given up. You cannot determine the fair value of the goods received. You cannot determine the fair value of the goods given up. How much revenue are you going to recognize? Okay, in that case, the revenue that you are going to recognize is actually the carrying value of the goods given up. Of course, as a business, you must have a record of the carrying value of the goods that you have exchanged. All right. Then there are some complex transactions and how we're going to recognize revenues of those. these complex transactions are like when there are multiple components of a transaction, when there is a combined transaction, and when there is a customer loyalty program. Okay, so when there's a multiple components of a transaction, so suppose you are selling goods. Suppose you are dealing business with selling, say, a refrigerator, fridge. All right, and when you sell goods, you also sell servicing. So what you're going to do, you say that I'll sell this fridge and I'll provide service to you for another 4 years. All right. So what you're going to do, you're going to recognize revenue separately for the sale of the fridge and for the revenue generated out of the servicing. Okay. You need to separate it. That is a standard requirement. You should not just boil it together. And if there are combined transactions, like you are selling some goods, which comes with a lot of other things, like you're selling a car, and the car comes with floor mats, window shield, window screens, those kind of things. And in order to determine the commercial value of the transaction, you cannot separate all these things, all right? That's coming with the car. So in that case, you recognize all the revenues together. There is no harm in it if you cannot separate out, okay? And customer loyalty, of course, customer loyalty is that you're saying that, okay, if you buy 40 items from me, and the 41st item will be free to you. If you buy 10 items from you and from me, and the 11th item will be free. So that is called customer loyalty. So even if you are giving free to the customer, but the standard says that that item that you're giving has got a value, and that value needs to be recognized in the standard. All right. So you need to recognize the total revenue. Needs to segregate the total revenue. The first revenue is of sale of goods, and the second part of revenue should be out of customer loyalty program. You need to disclose them separately. So again, why we're doing this? We're doing this because, you see, I said that if all entities, they follow this disclosure requirement and everything, then the comparison will be possible and easy. All right, because we are running out of time, so I have used some examples which are self-explanatory. For example, I'll go through them quickly. So for example, multiple components. Moscow sells machinery to clients, 5 million. Of that 5 million, the revenue out of machinery is 4 million and 1 million for servicing for 4 years. So Moscow is going to recognize 4 million is sale of goods revenue, and that 4 million over the 4 years, 1 million per year will be recognized as a service revenue separately. That is what the standard is recommending. Similarly, customer loyalty program. There's an example that Oslo sells bottle of health drink for 50, and Oslo says that who buys a bottle of drink for $50, they can buy an energy bar paying for $5. Normally, energy bar costs $9. Okay, based on the history, also knows that 40% of his customers will take this opportunity of this loyalty, and the drinks actual selling price is $40, $46.50. Okay, so what happens is that how we're going to recognize this revenue? This is a very complex situation. All right. Now, first thing that you need to find out whether this loyalty value, customer loyalty value, has got a market value. If it has got a market value, then you are going to recognize the revenue is in that market value. But in 99.9% of the cases, there are no market values. Not possible, because each company's loyalty program is different to another company. So the question asks that provide a journal entry for the sale of health drink to Oslo using 2 scenarios, that the estimated fair value, award credit based on difference between sales price and without the award credit, and the estimated fair value, award credit based on estimated percentage customers that will use the award. Okay, now you're not accounting students, you don't need to learn the journal entries, okay? So what you need to learn here only that how the calculation is done, all right? So in case of this loyalty value, the revenue is recognized in such a way that actual price of the drink is $46.50, okay? But if a customer buys $50, you'll get a health bar. So the fair value of the health bar should be $3.50. So your sale of goods revenue is going to be $46.50, and your loyalty revenue should be $3.50. Okay, and total will go to bank $50. Don't bother about these debits and credits. Okay, you don't need that. And for the second one, 40% of that loyalty program will take this opportunity. So a bar costs $9, but this company actually charges $5 for this loyalty program. So the difference the customer gets is $4. Of that $4, 40% will be realized. 40% customer will actually avail this opportunity, which comes to $1.60. So revenue out of sale of the drinks would be $40.40. Revenue out of the loyalty program will be $1.60. See, so there are two alternative choices that you can use. Now, you may be thinking that, okay, company X uses this one, company Y uses this one. And Professor Monir said at the beginning that a standard will help for comparison. But if different companies use these different methods, how are we going to compare? All right, that's difficult. But a standard says that you also have to make a disclosure in your financial statement which method you have followed. All right, so that a user can actually understand that company X uses this method, company Y uses this method, and when comparing, can accommodate this difference in determining their performance. You need to disclose the process. Okay. Then there are three sources of revenues. I said at the beginning: sale of goods, and then sale of services, providing services, and construction contract. Then at what point we are going to recognize revenue out of sale of goods? There are 5 conditions that has to be made. First thing is that the seller must transfer the risk to the buyer. The seller must transfer the management and control of the product to the buyer. Okay, the amount to be measured reliably, and the economic benefit must flow through to the seller. I mean, the buyer must pay, and the cost related to that sales can be determined or measured reliably. If these 5 conditions are met, then you're going to recognize revenue out of sale of goods. The question is, if one of them is not recognized, if of them is not met, what you are going to do? Okay, then you need to follow your judgment. Okay, you need to disclose that in your financial statement, that one of these or more, one or more of these conditions are not met. So that particular amount we didn't include in our sale of goods revenue, we included in our other revenues. Okay, you need to disclose that. Then there is an example here. Please go through this example and you'll understand. But anyway, I'm going to explain you again. There are St. Petersburg sells televisions to customers, 60 days to pay. 60 days to pay. All right. So television customer buys, take home, but will pay within 60 days. Is St. Petersburg is going to recognize this revenue as sale of goods? So to determine that, you need to check those 5 conditions. All right. The first thing is that is the risk is actually transferred. All right. So think that it's good is the television is actually sold, and the customer is going to pay within 60 days. Literally, it means that the risk remains with the seller, isn't it? The customer may or may not pay. All right. Which means that he cannot recognize this as a revenue if the risk is there. All right. But down at the bottom, St. Petersburg confirmed us that, yes, that this customer is a good customer and never fail to pay within 60 days, which means that St. Petersburg literally transferred the risk to the customer, which means that in this scenario, the revenue will be recognized as sale of goods. Okay? And rendering services, when you provide services, for example, you are doing a consultancy business and you provide consultancy services, how you are going to recognize this revenue? Again, like sale of goods, there are some conditions to be met to recognize service revenue out of service as revenue. Okay, the first thing is that the revenue can be measured reliably. Okay, the economic benefit must flow through, and you must determine the stage of completion of the service reliably and the cost incurred to provide that much of service. You can measure it. So if these conditions are met, then that service revenue will be recognized as revenue out of service in your income statement. Okay, if one of these conditions not met, then you are going to use your judgment. All right, and the recommended process is that you disclose that in your financial statement, and you say that one of the conditions as per the standard was not made, and as a result, we are showing this revenue as other revenue or miscellaneous revenue, something like that. Okay, and the main important criteria is that you need to determine the percentage of completion of the service to be provided. Okay, so for example, Stockholm is providing 2-year management project to a mining company. Total contract price is 1 million, and this Stockholm actually incurred so far $270,000 as cost. Additional cost $130,000 to be incurred in future. Total cost to be incurred $400,000. Okay, how much of this 1 million they are going to recognize as revenue on their reporting date? So what to do? You need to calculate first percentage of completion of the surveys. How to calculate that percentage? Look at here. They incurred $270,000 as cost, all right, of that 400,000, which means they have completed so far 67.5% of their services, their management services, which means that they can recognize 67.5% of 1 million as revenue for a reporting period on that 270,000 cost reporting date. So the revenue is going to be 675,000. Their cost of sales 270,000. Their gross profit is 405,000. See that if all the entities follow the same process in recognizing their service, and then you can easily compare the gross profit actually determined by them, and you can compare their performance. That is the beauty of following the standard. There is a beauty of making standards mandatory. All right. Sometimes service contract become a bit complicated. Sometimes somebody might accept a service contract for the first time, knows the total value of the service contract, but has got no idea how much cost is going to be incurred in future, can only say how much cost been incurred so far. Okay, so in that situation, you cannot really calculate percentage of completion. How are you going to recognize revenue in that situation? You only use these criteria, the costs that have been incurred so far, and that is going to be revenue that is to be recognized. So in this situation, revenue is 150,000 and cost of sales is also 50,000. So far, gross profit is 0. So you can say that then what's going to happen? Yes, when the contract will be finished, service contract completely, on that day, they will be able to find out the profit out of that contract, because by the time they'll be able to know total cost of their service. And the next one is construction contract. And also, again, like sales of goods, service contract, there are some criteria to be met to recognize revenue out of construction contract. All right. Construction contract is similar to service. All right. Main thing is that you need to find out the percentage of completion of the construction. all right? And to calculate the percentage of completion, exactly need to find out how much cost you have incurred so far for the construction and total cost to be incurred. And they calculate the percentage and then find out the revenue, exactly like service contract, okay? So even we are recommended to use the method of percentage of completion, but the standard recommends that you try to find out the accurate percentage of completion, okay? The actual percentage of completion. And how to do that, all right? The standard says that the first thing is that you calculate your cost accurately first and calculate how much construction been completed so far. If you cannot do that, then what you do a survey. You go to the project yourself and then check everything and then determine how much been completed. You cannot do that, then what you need to do, you need to actually go for again to the site and check the physical proportion of the contract that have been calculated. So I'm going very quick because we're running out of time, but these are kind of self-explanatory. And I said that always try to understand, okay? So construction contract revenue recognition and service contract revenue recognitions, they are almost similar. Okay. So there are other revenues that needs to be recognized by an entity. The standard says that a business can earn something out of interest for the money it invested, or maybe a loan provided to somebody. A business can earn income out of royalties. Business can earn income out of dividends. Remember, these three incomes, these three revenues are not coming out of the ordinary activities of the business. Unless a business is something like a financial business, which buys shares and sells shares, something like that, or it's a money lending business, or it is a book publishing business, something like that, then royalties may be there, ordinary activities, all right? But if it is not, then these are not an ordinary activity revenue of a business. So how interest to be recognized? It says that interest to be recognized at effective interest rate, which is very, very important. So when you recognize interest, you need to use effective interest rate. The difference between effective, the opposite is nominal. Nominal interest is that you do not use compounding. And in effective rate, you use compounding. Compounding, of course, you know that. You did it in your high school, of course. I know when you did your arithmetic. Compounding interest is that you not only pay interest on the principal, you also have to pay interest on the principal plus interest and interest on that. That is what is called compounding. So when you recognize revenue, you follow this compounding method, all right? Unless you have got a specific contract that you'll only be using simple interest with your client. And in that case, you need to disclose that separately in a financial statement that you have your simple interest because there's a specific contract with your client. Royalties must be recognized on an accrual basis. What is accrual basis? In accounting, accrual basis means that once a contract is finished, once an invoice is actually issued, you need to recognize it as a revenue, irrespective of whether you receive cash or not. That is the accrual method, okay? So you have sold a good and you issued an invoice, all right? And the customer is going to pay you after 60 days. Are you going to wait 60 days to show it as a revenue? No, all right? As long as it's been sold, invoice been issued, you can recognize a revenue, which is called accrual basis, okay? Provided that all those other criteria of sale of goods are actually met, okay? Similarly, royalties needs to be recognized on a accrual basis. So you signed a contract of a royalty and you still haven't received the money yet, but you need to recognize that royalty as revenue on that particular period when the contract is signed. And dividends, you invested some money in some companies, when you are going to recognize dividends, all right? There is a criteria and it's very, very crucial. A lot of entities, they make a mistake in that. And the standard is very, very specific about it, all right? So suppose shareholders of a company, suppose the management of a company, all right, take a decision that they're going to declare 5% as dividend. Take a decision in November 2020, for example. In November 2020, okay, management of the company decides that they're going to pay 5% dividend. The question is, you have got some investment in that company. Are you going to recognize that 5% dividend as revenue, other revenue? The answer is no. You're not going to recognize that revenue in 2020 unless the dividend is approved by the shareholders in annual general meeting. So when the shareholder approves, that is when it will become your revenue. So you'll not show that dividend in 2020. If the dividend is approved by shareholders in 2021, say in January or February, then the dividend will be shown as revenue in your business in 2021. So you have to be careful. Just by management declared dividend doesn't mean that you already got a revenue, you are going to recognize it. You have to wait until it is approved by the shareholders in the annual general meetings. Okay, so I've got a couple of examples about interest and how the royalty to be recognized, all right, and how dividend to be recognized. These examples actually give you idea what exactly I said, how they are going to be recognized. What I want you to do, go through these examples. They are self-explanatory. Okay, if you have got any issues understanding complexities or anything, any term, of course, I said that you can raise your hand now, or you can send me an email later, or you can send an email to Professor Charamati, who can then forward it to me, and I can respond to you. Okay, what I'm saying that try to understand conceptually. Do not try to memorize. If you try to memorize, that is going to be suicidal. All right, so try to understand conceptually. So disclosure, as I said, from time to time that you need to disclose all these in your financial statement, and the standard actually recommends us how we are going to disclose revenue. First thing is that you must disclose accounting policy that you have followed in disclosing, okay? That I gave an example that suppose a particular sales is not meeting all those 5 criteria to be recognized as revenue, all right? So you are going to disclose in a financial statement that you have not recognized these and these revenue as a sales of good, rather you recognize them as other revenues. That is the policy, accounting policy that you have followed. And then you actually disclose the methods that have been used in calculating percentage of completion for your service contract and for your construction contract. Okay, and financial statement, then you need to categorically recognize revenue under each of the heading. Revenue out of sales of good, revenue out of rendering services, revenue out of interest, revenue out of royalties, out of dividends, out of commissions, if you're an agent, revenue out of government grants, we're going to talk about it soon, and any other significant type of revenues. So need to disclose them separately. So if all the entities, they do it, of course, then you have got a very good financial statement of all these entities. And we, as a user, we can compare, all right? And we can determine the performance of a business. All right. And then, of course, there's a slide on difference between IFRS for SMEs and IFRS for full IFRS. And they say that what is the difference? You just need to know. You don't need to memorize that. Okay. But the basic principles are same. I highlighted in yellow. Okay. Professor Charumati, do I have a few more minutes?
Yes, Professor, you can continue. You can also take 10 more minutes till you complete your 40 slides. Yeah.
Thank you very much. So I have got a question here. Do it yourself. Please go and check these. There is exactly similar example I showed at the beginning, but I made some little changes here. You need to find out what changes are there or changes there, and then you find out the revenue to be recognized, and tell me whether you are in agreement
I will
million now.
post it in the Google Classroom, Professor. They will submit
Okay.
the answer. Yeah.
Okay, thank you.
Yeah.
All right. Okay, so our next topic is government grant. As a business, you might receive some government grant and you need to recognize it separately. All right. You cannot put that government grant in your sale of goods. If you do that, then you will be misinterpreting, miswriting your income. All right. And users will not be able to compare it. It's a gross violation of revenue recognition. So government grant should be recognized separately in your income statement. Now, apparently it looks like very simple thing. It is true, it is very simple thing, but there's a crucial thing that you need to remember about government grant, because there is a difference between government grant and government assistance. All right. So there are two criteria to be met to be a government grant, to be recognized as a government grant in your income statement. If these two criteria are not met, then this grant will be recognized as government assistance. All right. So what are the two criteria? Number one is that there should be exchange of economic resources, which means that you literally get money from the government, hard money. All right. You get it. So there is a change of economic resources, exchange of economic resources. All right. That is when you recognize government grant. Now, if you cannot, so if you cannot get economic resources, for example, you get free advice or consultancy from government, that cannot be recognized as government grant. All right. Sometimes government gives a grant in kinds. I mean, other than consultancy, other than advice, in kinds. Maybe government can give you a big machine, a boiler, okay, a photocopy machine as a grant. In that case, if you can determine the fair value of that machine, all right, if you can measure the value reliably, you can recognize that as government grant. You must show that value in your income statement. Okay. Now, if you cannot distinguish your trading, in normal trading, with the transactions that you make with the government, then that is not actually going to be a government grant. Maybe the government actually contracted out you to do some jobs, contracted out to give you to do some jobs. So which means that you are receiving money out of a service contract. So that's going to be service revenue. That's not going to be government contract. Okay. So how you are going to recognize, how you're going to measure government revenue. And the point is that whenever any government grant is given, I think many of you have probably got some experience in that, it comes with terms and conditions. It doesn't come free. So government says that I'm giving you $1 million. I'm going to give you $1 million as grant. All right. But the money will not be released at a time. All right. So you have to perform, you have to fulfill some performance criteria. So if you perform up to this much, I'll release $200,000. Then if you perform up to another this much, I'll release another $200,000. So how much you're going to recognize as revenue as government grant? Only that much of performance you have done and the money that you have received against that performance. That portion is going to be your grant. Okay. Now, accounting standard also says that when you receive $1 million grant, you can show that grant in your balance sheet, not income statement. The money, $1 million, not income statement, not as revenue. You can show that as a liability, income received in advance, grant received in advance, not income. Okay, that can be shown as a liability, the total amount. But you only recognize revenue, that portion for which you have already performed, not more than that. So that is a standard saying. So if all entities follow that, we can easily compare even the grant performance of the entities. All right. So that is the way government grant is actually recognized. But remember, if you cannot measure the value of the grant. It came as a non-monetary, like advice or consultation. All right, that will be an assistance, and you don't have to show that in income statement if you have any assistance. But although IFRS for SME is very silent on that matter, about many entities, they show that by way of footnote in the financial statement that we receive some kind of non-monetary assistance from government, but there is no obligation. But some entities, they do. And the final one, so this is summary. Okay, I'm just repeating that. And the final one is borrowing costs. All right. So if you borrow money from another organization to run your business, how are you going to recognize that cost? All right. It's the same principle when you lend money. The principle is that you need to recognize that interest cost based on effective interest rate. Effective interest rate is actually your compounding interest rate. You need to use that. But unfortunately, IFRS for SMEs is more or less silent about the disclosure requirement and recognition requirements of the borrowing costs. So it's mainly your own judgment how you are going to disclose it. I think it is a very crucial point. I don't know why they're silent. Eventually, I think there should be an exposure draft on these. And I think a standard will come out how you are going to disclose borrowing costs. So that is what exactly I was supposed to tell you. So please go through the slides, check those, try to understand conceptually, get some interest in it. All right. Don't go for complicated calculations. Okay.
Thank you.
All right. So anybody got any questions? I've got time for 1 or 2 questions. All right. If not, so you can always send me by email.
Could you tell about the grant?
Okay. Sorry. Who is it? Sham, what is that?
Could you tell about the grants, sir, in foreign assets? $1 million you explained, no?
That $1 million grant somebody got from government.
Yes, sir. Yes, sir.
Yes. So if somebody gets $1 million as a grant, that entity is not going to show that $1 million as a revenue if there's a performance condition attached with it. Okay. So government doesn't release $1 million at a time. Government gives some performance criteria. Says that if you perform up to this much, then you'll release this much of money. And this much of money will be shown as a revenue. Okay. But an entity can show that $1 million in the balance sheet, not income statement. In the balance sheet as income received in advance. So when an income received in advance for which service not yet provided is a liability of an entity. Okay. And that is shown as a liability. All right. But only, yeah, go ahead. Yep.
Yes, sir. Yes, sir. You continue,
okay?
Sir. Yeah.
Okay.
It's okay.
So that's what I'm saying. So if you get a grant, you always see that there is a performance contract attached with it. And if you perform, you get some money out of that grant. I mean, cash will come out, and that cash will be shown as a revenue out of grant. Okay. But the total amount you can always show in the balance sheet as a liability, not as a revenue. Okay. Any other questions? Okay. If not, then that's all for today. Thank you for listening. Thank you for being patient. Thank you, Professor Martin. Now I hand over to you.
Yes, thank you, Professor Monir. The class was very interesting and very lucid style. You have explained the concepts. Actually, they have learned an accounting for managers paper, which I taught them. So they have the basic knowledge about it, though there are some BCom students, but your explanation made them understand very easily. So very clear, crystal clear explanation, and your experience really made them to understand and real life examples what you have given. Actually, they loved this class. I hope I got a lot of feedback also.
Hopefully.
I think from students also, anybody would like to give any feedback also, you are welcome.
You're welcome. Thank you.
Yes.
Sir, thank you for your practical teaching from equity to grant.
Okay, you're welcome, Shyam. Yep.
Thank you for giving your time and presence in this class, sir.
Thanks, Sham. Hopefully, all of
Thank
you
you.
enjoyed.
Thank you, Professor Monir. And we will have the next session on 19th as
On the
planned
19th.
at 8:30. Okay. That you can have little longer session so that
Yeah.
we can cover remaining topics.
Okay. Good on
Thank
you.
you, Professor. Thank you.
Okay. I'm
Thank
leaving now. Bye, everybody. And Eid Mubarak to those who are
Yeah.
celebrating it again. Bye.